Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. During this episode, we will actually discuss tax considerations in private company transactions. So we have the privilege to discuss these issues with a tax accountant and business valuation expert in Franklin and Nashville, Tennessee, Brad Smith. Successful businesses are being approached by buyers and saying, hey, we've watched you, you've had a 30-year business track record, and we'd like to buy you. But they kind of come into there with, we'll buy you for this amount. And the business owner has no clue of what they're getting. So then we have to kind of transition and talk to them about purchase price allocation. And
Sure.
How does that, in your perspective, how does it impact the transaction?
Well, significantly, and this is where your transaction advisor can really bring value to the table. So there's a multitude of things that can go on, and every company is different. But basically, big picture, the purchase price allocation is a means for assigning the total deal price to the underlying assets of the company. And let's taking a step back, assuming this is an asset sale. That's probably the easiest example. The tax code under Section 1060 actually requires that we follow a certain procedure. It's called the residual method. And the government gives us 7 classifications of assets that we need to utilize in this division. And we start with cash equivalents. We work our way through marketable securities, receivables, inventory, fixed asset items. Then we get into the intangibles, which might include items like non-competes, patents. And then interestingly, the final category is goodwill, which is kind of a leftover, right? So unlike you, Melissa, the IRS cannot evaluate goodwill with precision. So they make us follow this methodology. Now, that's not to say that we can't define the value, but it is a proactive element. I've been involved with a number of engagements where I was not maybe the transaction advisor, but I was just the CPA helping sort it post-closing. And leaving your purchase price allocation as a post-closing event can result in some unfortunate outcomes for sure.
Mm-hmm. And I think business owners kind of understand their inventory. They understand their accounts receivable, and then they have like their fixed assets, which is their actual things, furniture, equipment and such.